Let me share my screen.
Dave
So,
K, Jimmy, hello.
if you guys have been with us for, I think it was a couple months ago, Nate, we introduced a concept of trading opening range breakouts or basically continuation patterns at the market open. A lot of times we'll see, uh, if I can get my screen to adjust. Holy smokes. I don't know what. Let me just restart this. Let me do this again. Sorry about that. Let me just see if I can share this screen. All right. See it? Basically, doesn't happen all the time, but about 76.5% of the time when the markets break in or outside either to the upside or below their opening range 15-minute high and low, you'll see a continuation pattern that day. So if the markets break above after the first 15 minutes, 76% of the time they finish higher. If they break below that first 15 minutes range, 76% of the time they finish lower. Does that make sense so far? And this is on the XSP that I'm looking at just because of the tax advantaged options. So basically what we did was we said, you know what? Let's build an indicator that can trigger these moments. I'll just zoom out real quick. You can see here, buy calls, right? Bam. Buy calls, a little chop here. Buy calls, bam. Buy puts, finish lower. Buy calls, finish higher. Does that make sense so far? Kind of what we're looking for. We're charting that first 15-minute range, high and low, and just seeing if the market's going to continue in that direction on a break higher or a break below. If it gets past 1030, I don't have an example here, but if it gets past 1030 and it didn't break above or below, we just don't have a directional conviction. No, this isn't the 4 p.m. payout, Susan. This is going to be what we're really going for here is about a 60 to 90 minute window where we can get about 50% return on investment using the zero DTE. So I would prefer not to hold until end of day. Sometimes that happens. Like let's say here you bought puts, it says buy puts. You probably were up a little at first when it gets you, but then ended up paying at the end of the day. But what I want to do and what I'm doing right now is testing it out. Um, Basically, when we get one of these entries, so buy calls, we would just do a zero DTE debit spread. So if this date was 6/16, we would buy the 6/16 601 call, sell the 602, pay about 50, 60 cents, set an automated target at 50%. Now, we probably would have hit it right about here and been out in about 45 minutes. So you put $1,000 in, make $500 in 45 minutes. You don't even have to look at it because once you set the trade, you automate the rest. But currently running it over here, and we've got today on the 5 minute chart, we had that nice opening range to the upside, it looked like, but after the 15 minutes settled in, we got an immediate reversal, and now we've broken the lows of the day. And so my indicator showing buy puts right now. Now, before I give you the puts, I'll just show you guys the testing that Nate and I have run so far. Um, this is using a debit spread, a zero DTE debit spread. We tested the SPY and QQQ. 81% of the time, you hit that 50% payout. And again, typically that happens before noon. 81% of the time since like the beginning of the year almost, since February. Profit factor 234, and you get to do this every single day for the most part when there's a signal. Some days there are no signals, but about 3 times a week we get a signal like this. So right now, I'm already in because I got this signal, buy puts. But what I would like to do, if I were you, and you can still jump in, but you would just go to the zero DTE. You can see the ones I bought, and we're just going to basically wrap it where we're going to use the puts. And if this is legit, you're getting a steal of a deal right now on these puts.
That can't be right, right? 41 cents?
There's no way. I would look for about 50, 55 cents. But ticker's XSP, you would want to buy the 20 June 25 expiration. What is this? 601 put. You would want to sell 20 June 25 600 put. Net, there you go, 57 cents. Around, I would say 50. 53 to 58 cents right now. And now it's at 60 because the markets are probably continuing lower. But basically, what you would do if you had this indicator is here at 9:55, you would got the alert like I did. That's why I was a few minutes late, set my trade. Uh, I just post. Is my screen working? I'm getting a spinny thing on mine.
Yeah, you're good. It's in there. Chat is in
All
there,
right, it's in the
guys.
chat, guys.
So just take a look there.
So what you would do is you would set that trade. Now, obviously, we're a couple minutes late today. They fired right at like 9:59, but it's bouncing all over. And then so what you do is you set your trade. So I got filled at 52 cents. Then what I do is immediately set a closing order at about 76 cents. Good to cancel limit, which then allows me to, once my trade is filled, once I set my closing order at the same time, I'm done for the day. I don't check back on this. I can close my thinkorswim, whatever. It doesn't mean it's going to work out. Doesn't mean it's guaranteed to hit. But so far from the testing, 81% of the time, it ends up hitting that 50% target. And normally that happens before noon. So again, markets can go all over the place. Right now, with the way my trade is set up, as long as we close below 600, which is right at our opening price, I'll make my full profit. However, we don't necessarily have to wait until the end of the day. Because if we get a flush out here to 597, I would bet that we're going to hit it in the next 30 minutes, 40, 60 minutes. Bill, you would do an exit. I do an exit target at 50% right now, 50%. So if I got filled at 50 cents, my exit would be 75 cents. If I got filled at 60 cents, my exit would be around 90 cents. But again, I apologize. I was 2 minutes late here today because I was messing around with this. And this was the first entry, which was right at 50 cents, which I'll try and spoon feed you guys some more of these. We did do a Telegram channel about 2 months ago, and it's just really, yeah, we were trying to automate it, trying to do a bunch of different things with it. It's just been a long work in the progress. But now I'm just going to try and spoon feed these to you guys for the time being. The underlying symbol is XSP. That's what I'm using. That's the mini SPX index. A couple benefits there is that you don't, no risk of assignment. So if you're worried about trading spreads and getting assigned, no risk of assignment, it's cash close. Also, there's a tax advantage. It's a 60/40 tax advantage. So if you trade the SPY or QQQ, you trade it for under 2 years, you're going to pay capital gains tax. The thing about XSP is that 60% of your gains are at capital gains, 40% are taxed at your long term. So it does have some tax advantage. It does work in SPX. Yes, Mary. So you'd see the same exact thing in SPX. The reason I'm rolling with XSP right now is just because the strikes are dollar strikes. So we can get filled for about 50 cents, 50, 60 cents. Versus if you do SPX, it's going to be the same exact process, same everything. It's just that the entry price is going to be a couple $100 instead of $50. So if you are someone who likes to trade larger size and you don't want to buy 100 contracts of XSP, just trade the SPX. You can also do it. I wanted to do it on the NDX, which is the NASDAQ's version of this, but the problem is open interest volume wasn't just great. And then XND, maybe one day we'll get volume to this, but this is the one it actually performed best on. I mean, look at that. Wow. The XND is just the same as XSP, but it's a NASDAQ's version. But right now, there's just not a lot of options volume there. Dick, this is an indicator that we've been working on. It just tracks the opening range, and then we just look for a continuation pattern. Again, the core underlying phenomenon is that when the stock market, when the SPY, after it sets its first 15-minute range, so that's what you see here, this first 15-minute range, if it breaks above that range before 10:30, about 75% of the time the market's finished higher that day. If it breaks below that range, about 75% of the time the market's finished lower that day. So right now, the odds are saying about 75% chance the markets are going to finish, the S&P is going to finish below 597. Obviously, that doesn't mean 100% of the time. There are other factors, but that's just the odds that we have here. And then by using this income-ish style debit here with the target, we're able to get it up to 81% of the time with pretty awesome stats overall, I think. So Oh, nice, Bill. Anyways, that's that. I know I flew through that, but if you guys want me to, I can try to keep spoon feeding these to you guys here in the opening playbook. I don't want it to steal the light, yeah, or the whole spotlight of the show. I don't want us to spend our whole time on this every day. But I am working. I've got a great team. They monitor this too. Thinkorswim's built where it dings me when we get an entry. So hopefully we can keep sharing these in the future. Seven XSP options. I've only offered values between 46 and 80. I'm not sure what you're looking at, Stefan. The indicator isn't, it's not available right now. We are still working on it, fine tuning it. I actually made some changes this morning to it, but I like it pretty simple buy puts, and we'll see how if we can hit our target today. But the idea is more often than not, we hit that target before lunch. So it's kind of a fun little quick morning trade for us.
Yeah, I like it. I'm obviously the results we saw in the testing so far were pretty promising. So keep trying to roll that out. It was hard to manage from just opening playbook standpoint of being live. So we're doing some stuff with the automation, getting the team to jump in and help. Um, just one of those things. Seems like too good of an opportunity to pass up. So we're going to work around opening playbook to get some of those opportunities.
Awesome.
All right. Let me revisit something here real quick that we talked about yesterday. I told everyone to vote on this. This was the question. And the question was, which one of these trades would you rather be in? I got lots of votes so far. Oh, what was it? 68 to 22 for the left side. But you guys can let me know in the chat as well whether you like the left or the right here. If now, when I say line in the sand, what I mean by line in the sand is I mean where the price can't go. The price has to stay above this level to win. So here you have this amount of room. This is all your winning zone, and then anything above that is winning zone. And here you have this amount of room. It's actually a similar amount of room. It's meant to be the same amount of room. But one, you have the stock going up, and one, you have the stock going down. And so the question was, okay, which trade would you rather be in? So let's see what everyone said so far. A lot of lefts so far. Okay, left, left, left. Hank says left. Edward says left. Dick, Jody, Sean, left, 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 left. Oh, we got one right. All right, Tom. Tom's a right. Left. Bobby's a right. All right. We got some rights in there, but probably about 80% left. Well, I'm a left guy. So I'm a go with the trend, stay below price where the market is already moving in that direction. Now, a lot of people like trading kind of into pullbacks. And so they prefer something that looks more like this. And so for me, I am almost strictly a momentum trader more than anything else. I like trending stocks. But the other thing that I like is simply timing and the reality that good stocks move up more than they move down. And so a lot of people will accuse me of oversimplifying that. And that may be true, but I like oversimplifying that because I think it's the strongest data point in the stock market. We are very blessed. Those of us who trade the U.S. stock exchange, we are very blessed to have a market that has continuously gone up a lot more than it's gone down. Really take almost any decade stretch, you're going to be net positive. Even after some horrific drops like 2008, still the recovery period much faster than other global markets. And outside of those extreme scenarios, the 2008s, the 2000s, most decades are extremely positive. And so that is a big blessing that we have for those of us who trade US stocks. But I also think it's the biggest advantage that anyone has trading the market. Graham and I spend day in and day out trying to find little edges in the market. And it's what I love doing. I love doing the data. I love doing the testing. But the most fundamental advantage to me is still the fact that the market goes up more than it goes down. That's kind of the biggest separation that you'll get. So the real question then becomes, well, how do you take advantage of that? One way you can take advantage of that is buy and hold. Not a bad way to take advantage. That's one thing that you can do, is you can simply buy and hold the stocks, and they will typically go up over time. But the other thing that you can do is you can trade something like this. So when you trade something like this, what you're doing is you're saying, hey, as long as the stock stays above this level, I'm going to make money. This is all money zone for me. And the cool thing about this is that the stock has lots of different scenarios. It can keep going up. It can go sideways. It can go down some, but not all the way. It can go down, more. But the other thing, and I think this is the one that a lot of people undervalue, is that even if the stock does go down below that level, with time on your side, it can go back up. And that still is a winning trade as long as it finishes above that level. And so for me, this is one of the big advantages. And I would say it is a key thing to understand of how to actually use time and market direction to your favor. It's not just trying to time, hey, I think the market's going to flip around here. You can do that, but if you're going to do that, you might as well buy calls. You're going to get a better opportunity on calls if you're trying to time a reversal. What I would rather do is take strong stocks that are more likely to go up, give them enough time where I can get a good ROI to go up. So obviously, you guys know what I've been working on to take it full advantage of that is the income machine. So let me give you a trade today from the income machine. Now, obviously, I don't really need to give you free trades from the income machine because you guys can just use the income machine for free yourself. At least try it for free. And this is on one of the strongest stocks in the entire market here on GE. Okay, so GE, one of the best stocks in the market, but has pulled back the last couple weeks by GE standards, which is not much of a pullback here. And if you go in and look at the opportunities for GE, there's some pretty nice ones in here. This one is 22% in 28 days. This one is 15% over a little bit longer time frame. And then this one is 47% over a little bit of a shorter time frame. Now, I already have quite a few expirations stacked up for that, so I'd probably end up sticking with this balance one. And what you can see here on the income machine that's so cool is exactly what I was just talking about, the cushion below price. So GE here is priced at $238, and yet the opportunity is the 210, 220 strike. And so what that's showing you is exactly this cushion, this line beneath the current price that gives you all that cushion. In this case, it's about $18, which is, 8% below the price of GE. And so for me, those are the kind of opportunities I like, where I can make 15%, 18%, 20%, and still have that kind of room below. So I'll pop this trade in here. This is on GE. Let me pop in the chat here. Now, obviously, guys, always check the price. Use a limit order here. Make sure you can at least get in, at 825 or below. The mid price are going to bounce around a little bit today. But that's the July 18. Gives me a little bit more time. Like I said, I've got quite a few positions stacked up for July 11th. So I'm trying to, have a different cadence. That's one of the things I talked about in the Income Machine Masterclass, which, by the way, we have another masterclass today. But I like to kind of spread out those expiration dates so that I'm not, I don't have 20 trades that are all subject to the same market conditions. So again, this is GE, one of the best stocks in the entire market right now. And here you can get pretty far below that price. As you can see here, this is what we call the profit matrix. The profit matrix here will show you all the different scenarios of what can happen to GE. And you can see this one's pretty crazy. Even if GE goes down 10%, it's actually a partial loss. It's not even a full loss at a 10% negative move on GE, which is just crazy. Now, that's assuming you get in, you're able to get filled here in that 820 range, which You have to probably play around a little bit here as far as actual fills, but great opportunity there on GE. Let me, Hank, can you, I lost your chat there. Hank, you said IWM. I need to look at. Let me go, Graham, if you don't mind jumping in here. Let me go take a look at that for Hank real quick. Okay. Yeah. Graham, are you talking? Because you're just muted for me.
That's great. I must have hit this button on this thing. This is a touchscreen mic thing, and every time I tap it, we had a question here in the chat why the income machine might not show. It's saying no spreads available. MCP is asking about ticker CIM and NYMT. And Nate, correct me if I'm wrong, but that would just be there's no good viable options right now. So like NYMT, for example, doesn't have weeklies. It only has monthlies, and I'm looking at the monthly calls, and there's a total of 252 traded of all of the calls available. So there's just no liquidity there.
Yeah. So, guys, the way that the income machine works is that I gave it very strict criteria for each approach. So, a conservative approach has to meet certain criteria. It has to give a certain amount of days, certain amount of ROI, certain amount of cushion. A balanced approach, same thing, has to meet. And then it's going to combine millions of combinations and find the best one within that box of criteria. But not everyone will have trades that meet that criteria. It'll literally combine every option available and say, sorry, there's no trades available that meet at least a 15% ROI with this amount of cushion. So you got to make sure that you're trading, within those reasonable ranges. And thankfully, the income machine does it for you. It'll just tell you if there are none available. Uh, yeah, Bobby, agreed. You could trade bearish stocks, and you'd still be going against, you know, uh, your stock would be moving against your line in the sand the opposite way. True. For me, though, like I said, the biggest advantage in all of trading is the market goes up more than it goes down. So you're still fighting against that kind of more fundamental, probability advantage, and that's really what I try to avoid. Now, there are some strategies where I trade the other direction. I'm not saying, I will never do that, but in something that I'm giving the market cushion, I'm trading to the for the income side of the equation, I really want time to work to my advantage. And I really believe the best way to get time to work for your advantage is to trade good stocks and trade them to the upside, because over time they are more likely to go up. I mean, it's like if you take any good stock, Apple, Microsoft, Walmart, GE, whatever stock you like, AGG, PGR. You take any of these stocks and you just run the numbers where you give it cushion on both sides. All things being equal, which side is going to take out the cushion more? Well, the upside is going to take out the cushion more because generally they move more to the upside. So that's kind of my default. Again, obviously, take it with a grain of salt. Lots of people trade different ways than I do, but that is what I think is actually the best way to take advantage of time that a lot of people miss out on. Let me address another question here real quick. I like to just kind of draw this out for people who are new, because someone asked about this, Graham, as well. Even on your trade, they said, on your trade, don't we need to buy it back at a lower price for your spread? The answer is no, guys. If you're doing a debit spread, you're treating it like a kind of like a call option. You want to buy for a low price, sell for a higher price. So in Graham's situation, which he is trading the downside, you have a stock that's moving down, and then you have a line in the sand here where you're trading for the stock to go below that. So you might have, I don't know, Graham, exactly what your calls were, but let's just make it easy and say you have
600 and 601 puts.
Okay.
And by the way, it's sitting right at the mid price already. So, I mean, that was a quick one this morning. Like I said, I typically want to get filled, hit my target before noon.
Yeah.
I got in at 9:59 and it's 10:27. Should fill any second now.
All right. So you had you said 600 and 601 is what you had.
Uh, yes, but you'd probably, if you're showing downwards, would you flip it or no?
Wait, it should be you did a bear put?
No, no, no. I did a bear put. I did yes, debit
Okay.
to the downside.
Okay. So if you did a debit to the down, wait, did I flip the strikes?
That's what I'm saying. I think your strike should be.
Oh, hold on.
It
Hold
looks
on.
like that in Thinkorswim. I don't know why they do that, but
Okay, hold on.
there you go. There you go. Scribble, scribble, scribble.
Doesn't that look nice,
So
guys?
my target sale price was 77 based on my average fill.
Okay. Doesn't that look pretty? Okay, this is a great example. Look how nice my drawing is so far, guys. Okay, so anyway, you paid 55 cents for this or something like that. So the question is, what's going to happen? Well, as the price goes down, it's not a credit spread where these are becoming worthless. What they're becoming is more likely to be worth this full dollar. So as price goes down, it's going to go from 55 to 65 to 75. And then eventually, what would happen if this expires anywhere below is that you would have the right to sell the stocks for, a dollar cheaper than what you own them for. And you would make the full dollar because that's the width of the spread. So that's why this is becoming more valuable, not less valuable. Does that make sense to everyone? So this is as it gets below the price. It's not like a credit spread where it's going to expire worthless when it gets below this line. It's a debit spread where it's getting closer to exercising for the full $1 value on both sides. So Graham did this as a debit, which means as it goes down, it's getting more valuable, not less valuable. Same thing we do on the upside, guys. So if we go to the upside here, and I have a trade that looks like this, where I bought, a 595 call, and I sold this $600 call. I did that as a debit. So I paid, $3 for it. Well, as it goes up and it stays above this line in the sand, it's not, I don't want this $3 to expire. I paid money for it. I want it to get closer to this $5 value. And what would eventually happen, let's say that, here's our expiration over here, and it gets to that level and it expires here. What happens is the broker says, okay, this now expired in the money on both sides. So both sides will be automatically exercised. However many contracts you have is going to allow you to buy shares at $5.95 and then sell those same shares at $600. That's what happens when these both exercise. At this expiration date, you're now buying shares at $5.95, you're selling them at $600, and so you're making the full $5. And you always know what the full value of a debit spread is because it's just the difference between your strike prices. So you always know, this is one of the reasons, by the way, that Graham and I tell you to use limit orders. Because if you're trading a $1 spread and the market lets you pay $1 for it, well, you now have zero potential for making money because the $1 spread max value is $1. So you always know what your max value is simply based on the width of the spread. If it's a $2.50 spread, the max value is $2.50. If it's a $1 spread, max value is $1. And then all you have to do for the math here, guys, is $5 versus $3. That's a 40% ROI. Now, again, the math is sometimes what gets people tripped up. So let's go to a trade like cost on the income machine and just go through the math here. So it's going to run. It's going to ping all the different options in the cost option chain. You can see here, no cost option fit the conservative, but we have a balanced opportunity. We have an aggressive opportunity. Let's click the balanced one. Here it gets us about $30 below price. But the cool thing is what the income machine is going to do, because like I said, the math can sometimes get a little funky. Well, guess what? It's going to do the math for you right here. When instead of asking me or saying, Drew, I think everyone can see my screen except for you. Everyone, can you see it? Drew is saying he can't see my
I
screen,
can see
but
it.
I think
You
okay.
might be able. Can you see Nate's face? There's a button in Zoom where you can say like switch to screen sharing that you might need to hit.
Yeah. So you might just need to hit one of those buttons, but it looks
Yeah,
like everyone else can see my screen.
about 100 people.
Everyone says see it. Cool, cool, cool. You can also like I think maximize the view, like go full screen there. But again, you guys don't need one of those Google Sheet calculators or something that we built because the income machine runs the math for you. Now, the cool thing that we just added, thanks to you guys' great request, we just added was what if I don't pay the exact price? So the recommended price is 420. What if I get in for a little bit better price? Well, now you can actually adjust what you paid. So instead of 420, you paid 403. Well, guess what? Now the calculator is going to automatically adjust it for you and do the math based on what you paid instead of just the recommended price. And then you can put in however many contracts you want. Hey, I'm going to trade 7 contracts of cost. Now it's going to tell you your investment is $28.22. Your income potential is $677. All right there for you, right in the same screen that it's spitting out the exact options criteria for you. So when Graham and I talk about doing the math, this is what you paid, this is what the full value is, all that kind of stuff. You don't have to do that yourself. You don't have to pull out the trusty calculator. The income machine bakes it all in, and it even has this kind of custom adjustment to go up higher. And you could figure out, obviously, if you pay much less, look, your ROI gets a lot better. So you always want to pay less for a debit spread. That's the other thing to keep in mind, guys. On a debit spread, it's really straightforward in terms of trade execution because it's like a call option. You always want to pay less and get more to get a better scenario out of the trade. So I had one other question I was going to whiteboard for you, but now I kind of forget what it was. Let me scroll through. By the way, if you guys have any other questions about kind of how this math works or the functioning there, just let me know. We can spend a couple more minutes on that. By the way, Graham, you and I have gone back and forth a little bit here on how aggressive we still are for market all-time highs. What do you think? I'm actually still going to say next week we get a melt up and we hit all-time highs. I'm going super bold.
Oh, sorry. I was trying to mute myself so I could clear my throat, and I kept missing the mute button. I think I know I said it since April, since we had the big crash. I said all-time highs in June, all-time highs in June. I do think at this point that's probably out of the equation, in my opinion, for the S&P. But I absolutely think July. And that's what I told you guys before. I think June, I think June, I think June. If not, definitely I'm in on July. So I do think we are about to see the markets really heat up over the next couple of weeks. We've seen the seasonality. We've seen where the markets sit at currently based on that seasonality, the presidential cycles. The first half of July is the very, 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 very best time in the stock market, historically speaking. It is normally by far the most the strongest time in the stock market. So I do think we are going to see all-time highs by middle of July. I don't think by 4th of July. I would love to be shooting fireworks off at all-time highs, but I think shortly after is where we're going to see some all-time highs.
I say by 4th of July, guys, melt up. Let's
There you
go.
go.
Okay, so this was the question that I wanted to get to. $99 call, $100 call. Okay, this is again debit spread, right? So this is a debit spread. We're looking for the market to go up. The question was, what happens if you flip these around? Okay, so if you don't do a 99 call and a 100 call where you're buying the 99 and selling the 100, right? But instead you sell the 100. Sorry. You buy the 100 and you sell the 99. Looks the same numbers, same levels, but you're flipping. Here, you were buying the 99 and you were selling the 100. What happens here? Well, yes, guys, you get a credit. This turns it from a debit spread into a credit spread, but please understand you're flipping the direction as well. Okay? So if you just flip it to get a credit, you are not just getting a credit on the same trade structure, you're also flipping the direction where now you need the market to go down for this. So I just want to be clear on this because we've got a couple questions. Yes, you can trade this as a credit spread, but just understand that if you're doing a call credit here, you're actually playing for the market to go down so that these will expire worthless. All right. If you wanted to do it directional, you would do the puts as a debit spread on the downside, or you would do the calls as a credit to the downside. If you want to go up, you would do the puts as a credit and the calls as a debit. So let me just write this out for you guys. Anyone who's new to using spreads, this is just important basic information that I think everyone should have. Okay. If you want to be bullish, call debit or put credit. If, well, I can't type. You want to be bearish, put debit or call credit. Okay, I will type this in the chat for you as well, but this is kind of the important fundamentals for anyone who wants to trade directionally with spreads. If you want to be bullish, you're going to trade the calls as a debit, or you could trade the puts as a credit. But if you want to be bearish, you would flip that around. You would trade a put debit spread or a call credit spread. Now, me, I'm a debit guy. I like the fact that the early assignment is not a risk. I like that the math is just easy to understand. I always know I want to pay less, get more. That's how I trade. But you can do the other one. Just understand that you're flipping when you go from debit to credit, both directionally and the type of the trade. Yeah. So one of the big questions, I guess, a great question, was, hey, why would I ever risk $850 to make 150? Why would I ever want an 18% ROI? Well, for me, those are actually many of my favorite kinds of trades. By the way, I covered this in the masterclass and on an opening playbook session, kind of going through the compounding here, where if you can get enough cushion on a trade, I'm happy to take a 12%, 14%, 18% winner on those. Because if I can win 90% of my trades on a 14, 15, 16% ROI, I'm going to have a huge net advantage overall. And I think that one of the things that people have learned that's really bad, for lack of a better word, is this idea that a negative risk reward ratio is somehow bad. Like, it's one of those things that I think sounds good when people say it. They say, like, oh, you should never trade with a negative risk reward ratio. And everyone kind of nods their head. Yeah, that sounds reasonable. That sounds right. In reality, it really makes no sense. It's just one piece of the equation. The risk reward ratio is one part of the math, and it all is dependent on the win rate. If you have a good risk reward, but your win rate's not good enough, well, it doesn't matter. If you have a bad risk reward, but your win rate is good enough, it doesn't matter. So it really has nothing to do with anything on its own. It has to be combined with the rest of the math that gets you to positivity. And so one of the things I'll always ask people, if they say, oh, well, you should never trade with a negative risk reward ratio, I'll say, well, what about, high frequency traders that make, that risk, billions of dollars to make fractions of a penny and make more money than any of us could ever dream of? That's the biggest negative risk reward ratio you could basically imagine. And they churn out money all the day long because they win 99.9% of the time. Would you take that? And the answer, of course, should be yes. You would happily take that. So I'm and by the way, just in case you guys are wondering, in all the study and data I've done, which is a lot on these different systems, negative risk reward ratio strategies actually tend to work better, even on really good stocks. This is one of the shocking things, Graham, I think we found with like Apex and some other ideas like this, is that you take a stock like Apple or Tesla or Nvidia, which you would think if there's any stock on the planet that would do great with like going for 10-to-1 risk reward ratios, because there's juggernaut stocks that have gone up crazy, it would be one of those stocks. And yet, if you run the numbers, kind of take an entry signal like a weekly breakout, or just buy it on the first day of the month, or kind of any generic trade, and you do it with like a 10% target and a 2% stop loss, or a 2% target and a 10% stop loss, every single time the 2% target and the 10% stop loss is more profitable, which is very shocking when you think about a stock like Apple or Nvidia. But the reason, guys, is because, like I talked about before, if you simply give the market room and you make it easy to get a win, the numbers start trending really, really well for you. So, not to get on an entire soapbox there, but I just think that's one of the big misconceptions that traders have. I'm not saying you should always trade with a negative risk reward. Certainly, there's other strategies that, like I do jump trades, which is the opposite, and Graham has the elite trade, which is the opposite. Certainly, times to do that, but I just think it's one of those big misconceptions when people say something like trade with a negative, never trade with a negative risk reward. I think, well, you must not have looked at the data, because that on its own, that really doesn't pan out too well. So, Graham, on your trade, you're using a target on that, right?
Yeah, so and I had to fly through because I was literally jumping on here the second I got the entry. I can do a little deeper dive on that maybe sometime next week. But yeah, so the thinking is on the XSP trades, we want to get filled for anywhere 40 to 60 cents, and we want to set a target around 50%. So my fill was about 52 cents. I set a target at 77 cents. I got filled. I do have some open right now, so you can leave them open. I mean, it's up 70% now on my XSP in about 43 minutes, so I can't complain about that. Just to set the stage, it normally doesn't happen this fast. This was an awesome one. I got filled in 30. I paid in 37 minutes. Um, Normally doesn't happen this fast, but so far so good. There you go. Sold XSP for 20%.
Yeah, that's pretty good. So one of the things that's different about the income machine is that my default on the income machine is actually to go ahead and let it run to expiration for full profit. And by the way, guys, we will, as we've been doing all week, for those of you who still haven't taken advantage of it, we'll give you an opportunity to do that next, because the income machine, there is a way that you can try it out completely free. That tool that I was just showing you, if you guys haven't seen it, this beast of a tool here, I'll show it one more time here, because it's just so fun to show how cool it is. This tool right here that finds the stocks, ranks the stocks. CEG, here's an opportunity, then runs through millions of combinations of options to find those trades, which it would take hours to do on your own if you were trying to find these opportunities. Then prints out the exact trade, then prints out all these. Look at this one on CEG showing even if the stock goes down 10%, you're going to get a partial win on the trade. Crazy trades that this thing finds. Just such good opportunities. I mean, I personally think it's the most robust, coolest thing that I've ever done. And so if you've been living under a rock and you haven't seen how to take advantage of this, there is a way that you can try it for free. And I do mean actually free, with no credit card required. We will do that here in just a second. Before we get there, let me answer one more question about this style of trading, because in most cases, I would trade like Graham trades on that XSP example. I would trade to put a target on, and if I get a decent enough move, I get out with the trade. However, with the income machine, my default here is actually to let the trade run all the way to expiration and go for the full value. And the reason is because the income machine is doing all this calculations, running through all the math, going through all those combinations to find the biggest cushion, with the assumption based on the expiration date. So it's running all the math based on that expiration date. And so I go ahead and trust that expiration date and the math that's running, and go for the full value there as my default. Now, there are situations where I'll get out early. I actually got out early on an IBIT trade this morning. Market popped up an IBIT. The trade was expiring today, and I was able to get a profit out of it. So I went ahead and closed it instead of waiting for it to expire today. So there are situations where I'll do it. I'll get out early, but my default is to let the trade run all the way through expiration and try to get the full value. And that way I kind of have these trades stacking up, like what I might call like a waterfall approach, where, I have some trades expire on July 7th, hopefully for a full profit. I have some trades expire, well, I guess it wouldn't be the 7th, July 11th for a full value. July 18th for full value, July 25th. And I kind of have these trades just circulating through my account, going for those full profits. So that's, again, that's kind of my default. Doug asked, how many trades do I take over the month? Well, it's a great question, Doug, because My plan was only to take maybe 2 a week or so. But I've been doing so many classes, I've been pulling it up so often, and just having so much fun that I have probably way too many trades open right now. So I would answer default, maybe take a trade for me like Monday and Wednesday or Tuesday and Thursday, so that way my cadence is reasonable. One of the big things, and again, we talked about this in the masterclass, one of the big things for me is that I don't want to have 50 trades open and have them all subject to the exact same market conditions, right? If I have 50 trades open, they all expire on July 11th, and July 10th, we get another liberation day. Now I just subjected every single trade to the same market condition. Where if I have a trade that's open on June 20th with the July 11, open on June 23rd with the July 18, open the next week with the July 25th. Now I'm kind of spreading out that scenario and that cadence of the actual trades, which means they're not all subject to the same market conditions. So again, we can go deeper into that. By the way, if you guys want to try the income machine today, if you're not already in, which I think most of you, give me a yes in the chat if you're already using the income machine. I think most of you already are. Graham, I saw yesterday, someone in the chat, I think it was Greg in the chat, said that he got it on Monday. He's already won 12 trades with the income machine, just getting out on some early profits. So he's not waiting for them to expire. He's taking profits. And he already has 12 winners under his belt, which is a lot more winners than I have over the last week because I'm waiting for those babies to expire. So cool. Okay, a lot of you guys. But if you haven't, we'll give you an opportunity to do that here. Yes. Okay. Graham, any other housekeeping before we do that?
If you haven't used it, give us a no. Because it is free. And in my opinion...
Free to try, Graham.
Free trial. No strings attached. In my opinion...
Someone said the other day, they said, I thought you were giving it to me forever for free. I said, well, let's not get carried away.
Okay, yeah. But it is free for that period. No credit card, no secret billing, no hidden fees. I guess I get confused sometimes while there's people in the chat who don't have it because there's no downside to having the free trial. No downside. You get to access it, see if you like it. If you don't like it, nobody else does that, Nate. So I'm really glad you've done that. I don't know of anybody else who has spent this much time and energy in developing something that is this amazing and then brought it out for free. So that's up to you, but there is no downside to trying it out for free.
Yeah, absolutely. Okay. Cool. Well, Shannon, I look forward to seeing you here at 2 p.m. in the class. All right. Well, thanks guys for jumping on. Hope you have an absolutely great weekend. But before you get your weekend started, you want to do 2 things. You want to watch the income machine presentation, and then you want to join me for today's masterclass. So those are the 2 things that I highly, highly recommend you do before you get your weekend started.
Awesome.